In 1999, two countries joined the same currency. They got the same central bank, the same interest rates, the same monetary policy. They could no longer print their own money. They could no longer devalue to make their exports cheaper. From that moment, both countries would live and die by the same coin. One of those countries became the most powerful export economy on Earth. The other needed 3 separate bailouts, watched its economy shrink by 25% in 5 years, and in 2015 came within hours of being thrown out of the currency it had joined 14 years earlier. Same coin, different countries, opposite outcomes. This is the story of what the euro actually was, and why it worked completely differently for Germany than it did for Greece. The euro was not a neutral instrument. For Germany, it was a permanently undervalued currency, weaker than the Deutschmark would have been, that made German exports cheaper for the rest of the world at every moment of the currency's existence. For Greece, it was a trap. It removed devaluation, money printing, and independent monetary policy at exactly the moment a debt crisis arrived that would have required all 3. The same coin, different effects. This episode explains why.
Chapter 1. What the euro was supposed to be. The euro was designed as a political project wearing economic clothing. The idea, articulated in the Maastricht Treaty of 1992, was that a common currency would bind European nations together so tightly that another European war would become literally impossible. If German and French companies used the same money, if their economies were locked together by a shared central bank, the two countries that had spent the 20th century destroying each other would be structurally incapable of returning to conflict. This was, in purely political terms, a brilliant idea. Whether it was also sound economics was a question that several prominent economists asked loudly in 1992 and were largely ignored. The specific economic problem those economists identified was this: a currency union requires what economists call an optimal currency area. Countries that share a currency need to have similar productivity levels, similar business cycles, so that when one country needs lower interest rates, the others do not simultaneously need higher ones, and either a common fiscal transfer system or highly mobile labor, so that when a recession hits one country, workers can move to another, and money can flow from stronger regions to weaker ones. The United States is a currency union that works, because when Texas booms and Michigan busts, workers move and federal transfers flow. Europe had none of these mechanisms. It had a common currency without a common treasury. The architects of the euro knew this. They hoped that economic convergence would follow currency union, that the shared currency would force fiscal discipline and structural reform that would make Greece eventually look more like Germany. What happened instead was the opposite. Before I tell you what the euro did to Germany and Greece, I want to hold this question. If you are about to join a currency that removes your ability to print money, devalue, or set your own interest rates, what do you need to have in place before you join? The answer to that question is the episode. Chapter 2. Two countries in 1999. The starting conditions. When the euro was created in 1999, Germany and Greece were in very different economic positions, and those positions determined everything that followed. Germany in 1999 was actually struggling. It was, at the time, being called the sick man of Europe. Reunification in 1990 cost more than anyone expected. The eastern states required enormous transfers, an estimated 2 trillion euros over 30 years, and the integration of a planned economy into a market economy proved slower and more painful than the optimists had predicted. German unemployment was above 10%. German wages were rising faster than productivity. German exporters were losing competitiveness relative to their neighbors. The country that would become Europe's dominant economic power was, at the moment it joined the euro, genuinely in trouble. Greece in 1999 was in a different kind of trouble. It had been kept out of the first wave of euro membership because its deficits and inflation rate were too high. It was only admitted in 2001 after reporting figures that, as it later emerged, had been manipulated. Greece had a structural problem that predated the euro: a large public sector, generous pensions relative to its productivity level, endemic tax evasion, and an economy heavily dependent on tourism and shipping, sectors that do not drive industrial upgrading. But in 1999, these problems were manageable because Greece controlled its own currency. When things got difficult, it could devalue the drachma and make its exports and services cheaper. The euro would take that option away. The specific starting conditions matter because they determined what each country would do with cheap money, and cheap money was what the euro immediately delivered to both.
Chapter 3. The Cheap Money Flood. What Greece Did. The euro's first decade, from 2001 to 2008, was a period of what appeared to be extraordinary success. For Greece, it was also a period of extraordinary irresponsibility, though in fairness, the irresponsibility was not entirely the Greek government's alone. Before joining the euro, Greek government bonds carried an interest rate premium. Lenders charged Greece more than they charged Germany because Greece was riskier. Greek 10-year bonds yielded around 18% in the mid-1990s, compared to German bonds at around 7%. When Greece joined the euro, that premium largely disappeared. Markets assumed, incorrectly but rationally given the political signals, that European governments would not allow a eurozone member to default. Greek bonds suddenly traded at rates close to German ones, 5 to 6% rather than 18%. This was a 12 percentage point reduction in borrowing costs virtually overnight, and the Greek government did what almost any government in history would have done with a 12-point reduction in borrowing costs. It borrowed. Public sector wages increased, pensions expanded. The 2004 Athens Olympics, the most expensive games in history at the time, were funded at costs that ballooned from the original estimate of $1.6 billion to a final tally closer to $11 billion. Infrastructure was built. Employment in the public sector rose. Greek GDP grew at 4% per year through the early 2000s, the fastest in the eurozone. From the outside, Greece looked like a success story. What was actually happening was a debt-financed boom that concealed the absence of the structural reforms that the euro required. Greek productivity was not converging with German productivity. Greek exports were not becoming more competitive. The private sector was not upgrading from tourism and shipping into higher-value manufacturing and services. The boom was built on borrowed money at artificially low interest rates, and the debt was accumulating at a rate that would only become visible when the borrowed money stopped flowing. Chapter 4. The Competitive Machine. What Germany Did. Germany, in the same period, did something completely different with the same cheap money, and in doing so became the primary beneficiary of the euro in ways that were not obvious at the time. Germany's response to its late 1990s economic difficulties was the Agenda 2010 reforms, implemented between 2003 and 2005 by Chancellor Gerhard Schroeder. The Hartz reforms, as they became known, restructured the German labor market, making it easier to hire and fire workers, reducing unemployment benefits to create stronger incentives to take lower-paid work, and allowing the expansion of part-time and temporary employment. The effect was to reduce German unit labor costs, the cost of producing 1 unit of output, relative to Germany's Eurozone competitors. German wages grew slower than productivity. German exports became cheaper. Here is where the euro becomes crucial. If Germany had still had the Deutschmark, the export surge that followed the Hartz reforms would have caused the Deutschmark to appreciate, making German exports more expensive again, and automatically limiting Germany's competitive advantage. That is how floating currencies are supposed to work. But Germany no longer had a Deutschmark, it had a euro. And the euro's exchange rate was set not by Germany's productivity, but by the average of all 19 eurozone economies, including the less productive, deficit-running southern members.
Every time Greece, Italy, or Spain ran a deficit and weakened the euro's value, German exporters got a bonus. Their goods became cheaper in US, Chinese, and Japanese markets without any policy decision by Germany. The euro was for Germany a permanently undervalued currency. Between 2000 and 2010, Germany's current account surplus, the measure of how much more it exported than it imported, rose from near zero to 6% of GDP. By the peak of the Eurozone crisis, it had reached nearly 8%, a level that the International Monetary Fund described as a major source of imbalance within the Eurozone. Germany was exporting vastly more than it was importing, effectively lending money to the countries that were buying its goods. Those countries included Greece. Chapter 5. 2009. The numbers are revealed. Everything collapsed in October 2009. A new Greek government, led by George Papandreou, took office and disclosed that the previous administration had been misreporting Greece's budget deficit. The true deficit for 2009 was not 6% of GDP as previously reported. It was 15.6%. The debt-to-GDP ratio, which should have been under 60% under the Maastricht rules, was already at 113% and rising. The reaction in bond markets was immediate and catastrophic. Greek bond yields began climbing within days. Within months, they had reached levels that made it impossible for Greece to finance its debt at sustainable rates. By 2010, Greece was paying 10% on 10-year bonds, while Germany paid 3% on the same currency with the same central bank for bonds denominated in the same euros. The yield spread, which should have been zero in a functioning currency union, had opened to 7 percentage points. By 2012, Greek yields reached 35%, and Greece's debt had been downgraded to junk. The crisis was severe in its own right, but it was made structurally worse by Greece's membership in the euro. A country with its own currency facing a debt crisis can devalue, making its exports cheaper, attracting tourism, and generating the growth needed to pay down debt. Iceland did exactly this in 2008, defaulting on its banking debts, devaluing the krona by 50%, and recovering to 3% growth within 4 years. Greece could not devalue. It had no krona to devalue. Its currency was shared with Germany. Greece also could not print money to service its debt. The European Central Bank controlled monetary policy for the entire Eurozone, and the ECB was designed on German principles. Its primary mandate was price stability, not growth or employment. The tools that most countries use to manage a debt crisis, devaluation, monetary expansion, default followed by fresh start, were all unavailable to Greece. Chapter 6. The Austerity Trap. What was available was austerity, and Greece received it in full. The Troika, as it became known, the European Commission, the European Central Bank, and the International Monetary Fund agreed to lend Greece money to service its debts on the condition that Greece implement severe spending cuts, tax increases, and structural reforms. 3 bailout packages were agreed: $110 billion in 2010, $130 billion in 2012, and $86 billion in 2015. The total commitment reached approximately $289 billion. The conditions attached to each bailout were demanding beyond anything in modern economic history. The minimum wage was cut by 22%. Public sector wages were cut by 20%. Pensions were reduced 12 separate times. The corporate tax rate was raised, then the VAT was raised, then both were raised again. Healthcare spending was cut. Education spending was cut. Infrastructure investment collapsed. The primary surplus, government revenues minus expenditure before interest payments, had to move from a deficit of 10% of GDP to a surplus. That required the Greek government to extract more from its economy in taxes than it was spending on its citizens during the worst recession the country had ever experienced. The economic consequences were historic in their severity. Between 2008 and 2013, Greek GDP fell by 25%, a contraction larger than the United States experienced during the Great Depression of the 1930s. Unemployment rose from 7.2% in 2008 to 27.9% in June 2013. Youth unemployment, the share of young people without work, reached 64.9% in May 2013. Not 64.9% of workers, 64.9% of all young people who wanted to work could not find work. 1 in 4 Greeks was unemployed. 2 in 3 young Greeks were unemployed. The poverty rate doubled. 1 in 3 Greeks fell below the poverty line by 2014. The austerity was not simply painful. Many economists argued it was self-defeating. The IMF itself later published a paper acknowledging that its models had underestimated the fiscal multiplier in Greece, the damage that spending cuts would do to economic output. The austerity that was supposed to produce growth by restoring market confidence instead contracted the tax base faster than it reduced the deficit. By 2015, Greece's debt-to-GDP ratio was higher than it had been when the first bailout began, because GDP had fallen faster than debt.
Chapter 7. The Irony of 1952. Now comes the part of this story that is almost never told in discussions of the Greek debt crisis, and it is the part that changes the moral weight of every demand Germany made of Greece between 2010 and 2015. In February 1952, representatives of 21 creditor nations met in London to discuss what to do about Germany's debts. Germany owed an enormous sum: the unpaid debts of the Weimar Republic, the Nazi regime's wartime obligations, and the post-war reconstruction loans. The London Debt Agreement, signed that year, canceled approximately 50% of Germany's total external debt. The remaining debt was restructured on highly favorable terms: long maturities, low interest rates, and a repayment schedule tied to Germany's economic growth, so that Germany would only have to pay when it could afford to. The total relief, according to economic historian Albrecht Ritschl of the London School of Economics, was worth approximately 4 times Germany's entire GDP in 1950. Nothing comparable has ever been done for any country before or since. The London Agreement was not charity. The creditors, led by the United States, made a deliberate geopolitical calculation. A prosperous West Germany was essential to containing the Soviet Union. Economic punishment of Germany would produce political instability that served no one's interests. Debt cancellation plus reconstruction investment, the Marshall Plan, was the foundation of the German economic miracle. Without it, there is no German post-war success story to contrast with Greece. The irony, as several Greek politicians noted during the 2010-2015 negotiations, was precise and pointed. The country most insistent on Greece paying every euro of its debts, refusing haircuts, demanding primary surpluses during the worst recession in European history, was the country whose own economic miracle had been built on the cancellation of debts it could not pay. Angela Merkel's government rejected this argument, but the historical record does not. Chapter 8. What the numbers actually show. The comparison graphic on your screen does not require much narration. Every row states the same underlying truth in a different number. But I want to draw your attention to 3 rows in particular. The first is unit labor costs. Between 2000 and 2010, German unit labor costs fell 10% relative to the Eurozone average. Greek unit labor costs rose 30% relative to the Eurozone average. In a currency union with no devaluation, that divergence has only one resolution. Either Greece must cut wages by 40% to regain competitiveness, which is what austerity demanded, or Germany must allow wages to rise, which it refused. The adjustment was placed entirely on the weaker country.
The second row is current account. Germany ran a current account surplus of nearly 8% of GDP at the peak of the crisis. Greece ran a deficit of 15%. In a functioning currency union with fiscal transfers, like the United States, money flows from surplus regions to deficit regions automatically. In the Eurozone, there were no such transfers. The surplus country accumulated claims. The deficit country accumulated debts. The third row is debt cancellation. Germany in 1952 received debt relief worth 4 times GDP on favorable terms tied to growth. Greece in 2010-2015, no principal relief on official debt, primary surplus during depression, austerity regardless of growth. The treatment of the two countries' debt crises 60 years apart was entirely different, and Germany designed both outcomes. Chapter 9. The Verdict. Greece in 2026 is in the most unexpected position in this story. It is recovering. The Economist ranked Greece the world's top economic performer for both 2022 and 2023, measuring 5 indicators including growth, employment, inflation, stock market performance, and debt. Investment-grade status lost during the crisis was fully restored by all major credit agencies by 2025. Tourism reached an all-time record of 32 million visitors in 2023. Unemployment, which peaked at 27.9% in 2013, had fallen to 7.7% by early 2026. Youth unemployment, once at 64.9%, was at 13.9%. The Greek economy is growing faster than the Eurozone average for the 4th consecutive year. The country that was nearly expelled from the Euro is outperforming the country that nearly expelled it. Germany in 2026 is in the most unexpected position on the other side. It is struggling. The German economic model, built on cheap Russian energy, Chinese demand for German exports, and American security guarantees, has been dismantled simultaneously. Russia's invasion of Ukraine ended cheap energy. China's economic slowdown reduced demand for German cars and industrial goods. Volkswagen, BASF, and Bayer are all contracting. Germany experienced a technical recession in 2023 and 2024. Industrial output fell 1.9% in December 2025 alone. The country that lectured the Eurozone on fiscal discipline is now debating a massive spending package, hundreds of billions in defense and infrastructure, under a new government led by Friedrich Merz. The irony is complete. The country that was disciplined is now spending. The country that was forced to cut is now growing. The currency that appeared to favor Germany at every turn has outlasted the model that Germany used to profit from it. The structural flaw in the Eurozone that this episode has described, common monetary policy without common fiscal policy, no adjustment mechanisms for weaker members, no debt mutualization, has not been fixed. The Eurozone is still the same institution it was in 2009. The next asymmetric shock will find the same vulnerabilities. Whether it comes from a financial crisis, a trade war, or a geopolitical event, the fundamental problem that the euro exposed in Greece still exists inside the architecture of the currency union. The euro is the same coin in every wallet, but what it does to you depends on whether you enter a crisis with German institutions, German productivity, and 1952's debt cancellation behind you, or whether you enter it with Greek institutions, Greek productivity, and nowhere to devalue. This is Macro Atlas. Thank you for watching.